everyone. My name's Erika Toth, and I'm Director of ETF Distribution at BMO GAM. I'm going to be your host for today's session, and I'm joined by my colleagues Bipan Rai, Managing Director and ETF Strategist, and Matt Montemurro, Managing Director and Head of Fixed Income and Equity Index ETFs. So today we're going to be talking interest rates and fixed income. The big news yesterday was the jump in Canada's inflation rate. We saw a jump to 2.6% in our annual inflation rate for February as the GST and HST holiday wrapped up. And that's actually the first time that inflation has run above target in Canada here for about 7 months. And it did register higher than expectations. So economists and markets have reacted to that since and are now pricing in about a 65% chance that the Bank of Canada will hold rates steady in their April meeting. And that higher inflation print is a week after the Bank of Canada's most recent cut. South of the border, we had the Fed meeting this afternoon, and they actually opted to hold rates given an anticipated slowdown in growth and also saw a bit of an uptick in inflation. So, Bipin, let's kick things off with you. What do you think are some of the factors that have led to this higher than expected inflation?
So it's exactly what you mentioned, Erica. I mean, if we look at the magnitude of the CPI print yesterday, certainly we are caught a bit off guard with respect to the surprise. The headline came in at 2.6%. I mean, that's well above what we and the street were expecting, which was closer to 1.8 to 1.9% on a year-over-year basis. And of course, the easy explanation here is that the GST HST holiday ended in the middle of the month, as taxes paid are included as part of the CPI calculation. But even if we strip those out and we look at, say, some of the Bank of Canada's preferred measures of core inflation, which generally, again, tend to be a good pulse check on the direction of headline inflation over the medium term. Both of the CPI trim and medium both expanded by 3.3% month over month, and those are now tracking at a 2.9% year-over-year clip. That's still a little bit firmer than the Bank of Canada would like at this point, and clearly there are signals outside of the impact of the GST and HST being included. Again, there are signals now that price pressures are a little bit stickier than we would have thought a couple of months ago. Now, looking ahead, the path looks a little bit complicated for the Bank of Canada. Indeed, it does feel like price pressures are going to be sticky for the next little while. There are a couple of factors that are contributing to that. First and foremost, we have the tariff story still very much a key, an important investment topic to consider. And of course, the retaliatory measures that the government of Canada takes will, of course, matter for the domestic inflation profile. Additionally, you have the indirect costs of the trade war for domestic businesses. I mean, it does take time to source new, trade partners and also keeping inventory on hold as well. Those costs tend to get passed through to the rest of the supply chain and do end up, factoring into consumer price calculations. Also, any residual impact from the GST and HST holiday and the fact that it was ended in mid-February, that will probably the residual effects will show up in the March print most likely. Offsetting some of those, of course, we do have the potential end of the consumer carbon tax as well to consider. So again, there's a fair bit of noise there when it comes to upcoming inflation prints that lead us to believe that we're probably going to be tracking around similar levels on a year-over-year basis relative to what we saw in February. And for the Bank of Canada, that means there's going to be a lot more two-way risk in the form of whether or not it decides to pause or to cut further. And right now, if we look at the way markets are pricing the Bank of Canada, we could see that there's close to 40% of a chance that the bank will ease by 25 basis points at its next three meetings. So again, very much a lot of things that are up in the air and really contingent on what the incoming data backdrop tells us.
Thanks, Bipin. Now over to you, Matt. How would you recommend positioning Canadian bond portfolios at this time? What would some of your top picks be right now and why?
Yeah, Erica, with more uncertainty around the next moves of the Bank of Canada, and most specifically, at what speed they're going to be willing to continue to cut rates. I think one thing we do think is that regardless of how much the Bank of Canada talks about the concerns around inflation, and that monetary policy alone will not will not be enough to offset the impacts of tariffs. We do believe that rates will continue to go lower, and meaningfully so if tariffs do continue longer than expected. While they may pause in April, as Bipan had just indicated with the markets pricing in, we continue to believe that the Bank of Canada is not done, and which means that we'll continue to see a falling interest rate environment as a whole. With that said, we do think we'll continue to see some yield curve normalization where much of the cuts will impact the short end of the curve, leaving longer term rates relatively stable. With that, we do see an immediate need. We do not see an immediate need to add duration to portfolios, and would prefer to sit on the shorter end of the curve and position our portfolio as shorter than the aggregate universe duration of approximately 7 years. So while we're cautiously optimistic in credit, as spreads have continued to be tight, with potential negative impacts of tariffs, as we look forward, we still think that the yield enhancement of corporate bonds is attractive at current valuations. We look to complement a core portfolio with short-term credit. I would favor ZCS or BMO short corporate bond index ETF, or ZQB, our BMO high quality corporate bond index ETF for positioning right now. The short end will reduce duration overall and could provide some near term upside with short term rates coming down. Specifically, that second option, ZQB, I think is very well suited for an environment where we're cautiously optimistic on credit. Investing in A-rated bonds and above should help reduce some of that downside risk on corporates, while still capturing an attractive yield and adding an aggregate duration of around 2 to 3 years. Both of these I think would be excellent complements to a portfolio, a core fixed income portfolio. Let's say adding this to a portfolio of ZAG or BMO aggregate bond ETF would be an effective way to remain invested, but while also reducing your overall duration in the short term to take advantage of some of the near term impacts.
Thanks for that, Matt. Bipin, back over to you. What are some of your key takeaways when we think about the Fed meetings over today and yesterday and the announcement this afternoon?
Yeah, so I mean, to summarize what we saw today, as you mentioned earlier, Erica, the Fed kept rates on hold. It did make an important announcement with respect to its quantitative tightening program. It is going to reduce the cap on monthly redemptions for U.S. Treasuries from 25 billion to 5 billion. That, of course, is to address the ongoing concerns with respect to the current debt ceiling situation that's unfolding on Capitol Hill. So those are the two important takeaways. But we also did get a round of projections from the Fed today. Not much change when it came to the distribution of median dots, implying that the Fed still saw the same number of cuts over the coming years, much as it did during the last forecasting round in December. But where the real story here was today was the fact that the Fed revised its growth forecasts lower, while at the same time revising its unemployment rate forecasts higher and its inflation forecasts higher as well. Now, that's not the type of revisions that the Fed wants to do, because it does accentuate sort of the trade-off between growth and inflation, and highlight the fact that those are often contradictory goals for the Federal Reserve. Again, it speaks to the degree of uncertainty that the Fed is heading into with respect to the unfolding trade and tariff backdrop. And during the press conference, Chair Powell did make mention of the fact that any near-term pass-throughs from tariffs to the inflation profile would be something that potentially they would look through based on prior experiences with tariffs. And so what that tells us is over the medium to long term, if the Fed is concerned about the growth profile due to the fact that we are seeing consumer and business sentiment being hit, then the likelihood is that the risks are going to be tilted towards further cuts. Now, the Fed did not indicate that in the dots, but that is certainly the salient takeaway for the markets. And as a result, we've seen somewhat of a bitish tone towards U.S. Treasuries. Of course, that might have been a bit more pronounced in the front end of the curve, and that opens up potential opportunities for investors to consider. Certainly, we are in this sort of environment where we see more cuts being priced into the Fed curve. To us, it does make a little bit more sense potentially to start looking at options, in the front end of the cash curve. And again, one potential option there is, of course, the ZTS, that is the BMO short-term Treasury bond index ETF. We do feel that there could be additional room for that particular fund to outperform if the market does get on board with the idea that the growth profile is likely to be lower in the United States and the Fed will respond with further cuts later in 2025, maybe even potentially into early 2026.
Thanks, Bipan. Now over to you, Matt. Our preference for the last little while, especially since Q3 of last year, has really been for Canadian bonds over US fixed income. Would you say that that's still the case? As Bipan was talking a little bit just now about the short end of the curve in the US, and one thing that I've noticed is that the very short end of the curve in the US still offers an extremely attractive yield. I mean, if you look at something like our ZUS.U, our BMO Ultra Short Term US Bond ETF, that's the US dollar units, the yield on that's still pretty attractive. So wanted to get your thoughts there in terms of relative positioning, Canadian versus US bonds. What's your outlook and what's your preference?
Yeah, absolutely. I think the latest Fed pause and the continued, inflationary impact that we're projecting that tariffs could and will continue to have on the U.S. economy. I think right now, as Bipin had said, we're pretty hesitant on U.S. duration. With no near-term impetus in expected rate cuts. I think if everything's getting pushed out later in 2025, potentially 50 beeps, maybe a little bit more. Right now, I think the short end of the curve continues to be our choice for positioning. Regardless, I would say, of the crowdedness of the trade. I think the short end has been a popular place for several years now. But if you look at it, there's still value in that. Like you had said, ZUS.U, a very attractive yield from that perspective, very little downside in terms of duration risk, and in a very uncertain interest rate environment, that is something that I think I can see a lot of investors hanging on to kind of or weather some of the storm that's ahead. I think ZUS.U continues to be a favorite for investors who really want to maximize yield, but minimize some of the volatility in today's markets. It provides a high credit quality. All the bonds mature in 1 year, which again, I think that helps you push some of that volatility down the road, allowing you to actually just capture bond maturities and then look to reinvest later. I'd also think about potentially adding a little bit more duration exposure. Like I do think that there is a chance we could see rate cuts sooner, and maybe having a little bit more exposure on the short end of the curve would be something. A little bit more duration exposure on the short end of the curve might be something investors want to look at. So, something to consider would be ZSU, the BMO short-term US IG corporate bond hedge to CAD index. It continues to look attractive, and similar to our position in CAD fixed income, it allows investors to remain short duration while maintaining still a yield premium over govies. Right now, if you look at duration, if you look at the mid part of the curve, you look further out, again, I think are on hold right now for US duration. So exposures like BMO midterm USIG, corporate bond hedge to CAD ETF or unhedged, so ZIC or ZMU. I prefer the positioning of the short end. If I was choosing between the belly and the long end, I think the belly does provide a little bit more. So you get that 5 to 10 year exposure versus long. I think there's more value there. So that's where I would consider, potentially complementing a ZSU exposure with a little bit more duration of ZMU or ZIC. Then you have the question about currency. I look at it, and I think we would continue to favor unhedged currency exposure right now. So we would be looking at ZIC. So that is the unhedged version of that 5 to 10 year USIG product. And I think we would expect a continued divergence of rates between Canada and the US. So I think that unhedged exposure would treat investors well. From a credit perspective, we have seen IG spreads widen in the last few weeks, but they were sitting on kind of 10-year tights. We weren't at the tightest levels, but we were nearing those 10-year tight levels. So I think we are cautiously optimistic in credit, but I wouldn't necessarily say we would be diving into US credit at these levels. We have seen some widening, so this is something to keep on the radar. But right now in the US, I think credit is very very tight, and it's going to be tough in terms of valuations, especially if there are headwinds in terms of the tariffs that we see ahead ahead. So, something to consider. But right now, I think given the greater macro environment, I think we're a little bit hesitant on credit. And if we wanted to go credit, we would focus on the short end with something like ZUS.U or ZSU.
Thanks, Matt. Bipin, I wanted to chat a little bit about your outlook on the REIT sector, since this is a more rate dependent segment of the equity market. It is attractive for yield as well. If we look at the ZRE, which is BMO's equal weight REITs index ETF, that's been outperforming competing cap weighted products year to date. If we consider ZRE, it has been under pressure if we look more recently, so like over the last 6 months. So what's your outlook for REITs? Would you say it's still a wait and see type game? And I also wanted you to comment a little bit on the subsectors in the REIT space. So for example, office versus residential versus commercial properties.
Yeah, certainly. I mean, we could talk a little bit about REITs. There's two factors I really consider. One is sort of the trajectory of inflation. Generally, when inflation is high and volatility in inflation gauges is high, you tend to see a sector like REITs outperform. Certainly, that was the case in 2022 when inflation was the predominant macro story for a lot of developed market economies. The other thing I look at is where the starting level is for interest rates and what we're projecting on a go-forward basis. Now, in the near term, if we're talking about, the uncertainty with respect to inflation, I mean, certainly there does appear to be some tactical scope, let's call it, when it comes to outperformance for the real estate sector, and I would surmise that we've kind of seen that already with respect to the behavior of the ZRE. But on a go-forward basis, let's say, tariffs are coming into play. We know that's going to lead to stickier prices potentially. To the degree that unmoors inflation expectations, that's obviously going to be a key consideration for central banks. But we could see some residual pass through to a sector like ZRE. So I wouldn't dismiss, this as more of a tactical trend. I would say that's probably going to be tied towards the price stability outlook, at least over the next couple of months. But beyond that, though, I've become a little bit leery, and that's because if we look at the starting level of interest rates, they're quite elevated right now. So naturally, I mean, it is quite onerous to take out a loan to deploy in the real estate sector. That also means the same thing for anybody else in the subsectors that are involved in the construction process and the like. So again, real estate further out beyond the next couple of months feels a bit of a dicey proposition. Not least as at least in our view, we're headed towards a slowdown phase of the economic cycle from the expansionary phase. On a subsector basis, there's no real strong conviction there, Erica. Certainly, there's still going to be the shortage issue when it comes to housing, the housing residential housing market in the United States. Certainly, that's been an important theme in Canada. You could also extend that to certain areas in the United States as well. I think there is a bit of concern with respect to the commercial segment of that sector in the United States for now. So I would tend to be a little bit more weighted towards the residential sector and see that as an outperformer given the supply constraints. But as an asset class or as a sector as a whole, I'm more optimistic in the coming months than I am further out.
Thanks. Now, another area of the market that is quite rate sensitive is the preferred share market. Matt, I wanted to talk to you a little bit about ZPR, which is the BMO Laddered Preferred Share Index ETF, which is the largest and most liquid preferred share ETF in Canada. The yield is quite attractive on ZPR. It has had quite good performance over the last year. What's your outlook for the rate reset preferred share market in Canada this year, Matt?
Yeah, so prefs and ZPR have continued to have a strong run after a extremely strong 2024. A big bounce back in positive performance last year, and that definitely has continued. One of the best performers year to date in 2025. Yields continue to look attractive. So while yields have come down, the 5-year Canada at, let's call it what, 271 continues to look attractive relative to 10-year averages. So yeah, it's not what it was in a year and a half ago, but we're still at a very attractive level. Adding that pref spread, still making it a nice yield play for investors. While the credit component of prefs could see some pressure, we said in the answer earlier, we are cautiously optimistic on credit, but we do want to make sure that we are monitoring it because spreads are tight, and we do realize that there's headwinds ahead of us, and that's the same type of lens we want to use when we were looking at ZCS and ZQB in that first answer. I think the big tailwind here in the pref market and what's really driving performance is the regular redemptions that we're seeing of rate reset preferred shares in the market, and then the subsequent lack of new issuance coming to the market. So what happens is that, when these redemptions happen, cash comes back to the market, and pref investors then go to look and spend that elsewhere in the market, basically pushing prices higher as investors, spread that cash throughout the market. So that's a nice tailwind within the market that's really driving some of the performance. But what it does also is it's shrinking the overall universe of preferred shares out there. Not to a point where you can't invest, but it is definitely a structural change that we are seeing over time as a lot of preferred shares are being called and redeemed, and potentially being reissued as LRCNs or institutional prefs, especially in the bank space. So this trend is expected to continue in 2025. So I think that's going to be another driver of performance. March itself, March 31st is an especially large month for pref redemptions. So expect to see some strong performance in the near term there. Comparing Canadian prefs to US, though, the US prefs have been much weaker. These prefs are perpetual in nature. That structure gives investors a long duration risk and exposure in an environment where we've seen over the last year where longer term yields in the US have actually gone up. So this has led to underperformance versus other asset classes of US prefs over the last little while. With continued uncertainty around Fed policy, the longer term impact of tariffs, which has been leading to longer term rates going up, I do think that I am concerned about the prospects of U.S. prefs right now. I'd be a little bit hesitant to add, what would be considered a long duration asset to portfolios, even though it's showing a very attractive yield measure at the current levels. Either way, I don't think if I was looking to add this exposure, I'm not sure I would look at something that was a 100% pure pref exposure. What I would look at is a hybrid exposure. We are looking at ZBI, which is our BMO Canadian Bank Income Index ETF. I think this is a great way. It's an excellent way to kind of walk that tightrope right now between exposure to prefs, exposure to LRCNs, institutional prefs, as well as getting 60% weight in Canadian bank bonds. So you're really getting the best of both worlds. You're getting that yield premium, but you're still getting that security and short duration solution within a bank context. So specifically ZBI, I think right now it's the only ETF in Canada that provides advisors with exposure to LRCNs and institutional prefs. So that gives them a way to get, known credit, so bank credit, higher yielding product, but also maintain that bank exposure. So again, a high quality exposure, and then you're overlaying that with some bond exposure. I think right now that's an excellent way for investors to minimize some of that duration risk, but still maximize yield in a credit that we all know and love.
Thanks, Matt, and thank you as well, Bipan. Thanks to both of you for joining us and for sharing your insights in a data-packed week on how investors should be positioning their fixed income given the current rates backdrop. So thank you everybody for tuning in. I do want to say stay tuned for next week's episode. We will be continuing on the fixed income theme, and we're going to be taking a deep dive, and we're going to focus on the target maturity bond ETFs, which BMO is going to be launching at the tail end of this week. Thanks, everyone. Take care.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.